All right, let's talk some stocks here. We got earnings that are finishing up for the banks and just beginning for everything else. Jeff Pierce, our contributor from St. Louis, joins us to first recap Bank of America, Goldman Sachs, and a few other stock stories we got to hit this morning outside the earnings category. Jeff, good to see you. How's your weekend, sir?
Hey, pretty good. How about yours?
Excellent. I'm ready to see some refrothing of the risk asset market. Seems like we're ready to rock and roll here. 1% in futures right now.
Yeah, absolutely. Same here. And, I think what we're seeing a little bit on the investor side is a little bit of optimism coming out of the banks. We saw Bank of America earnings, for example, coming in. There were mixed results. The earnings per share missed at 73 cents versus 78 cents was expected, and that's down about 29% year over year. Revenue was mostly in line at about $22.7 billion. We look at that net interest income, that increased 22% to $12.44 billion. That's compared to just over $10 billion last year. Non-interest income, fell by 9% year over year. And if we look down the line, what we've seen out of these different banks that have already reported, investment banking has been a real issue. It was an issue for Bank of America as well, as fees fell 46% from a year ago. Fixed income and equity trading were both up, as we've seen out of other banks as well. On the loan side, they saw loans and leases grow by about 12% from last year. Commercial loans up 16% and consumer loans up 7%. So some decent numbers coming out of a Bank of America, although there are certainly some results that could be concerning for investors going forward.
Okay, so tell me about that latter part here. The hang up is that revenue has declined in pretty much all these companies, right?
Mm-hmm, absolutely, yeah. The hang up is the revenues decline. They're seeing fixed income equity trading rise, but that's a lot to do with volatility, right? So we're seeing companies like Goldman Sachs do fairly well during volatility because of that side of the business. On the bank side, the loans are picking up. The interest rate is rising because of these loans, but the concerns are some of these numbers show maybe that consumers are getting concerned about the state of the economy. Ultimately, some of these interest rate issues that are helping the banks right now could end up hurting them in the long run. And I think, the banks are also concerned about, loans going bad. There have been building up reserves, although Bank of America did release about 48 million of reserves in the quarter compared to about 2.2 billion last year. But they have their loss provisions at around 500 million.
Okay. All right. Up shy of 2% right now. Pretty good. Falling on to last week, too. The kind of technical position for these banks is a tricky one, though. A lot of them either made new lows or were just at them right before these earnings, like Bank of America, which last week literally ticked to a low for the year at one point, we see here on the bottom right. So just still a tough one to kind of get too excited about, where they do trail the broader market where Bank of America made that low. And so it's not like the broad market where we haven't put in a new low for over a month now for the NASDAQ. That was on June 15th. So still, at least seems like the market's giving them a chance, but we need to watch for more here. They're kind of also seemingly kind of tied to all the same thing. It doesn't seem like we're getting a lot of different action. I know that you've got the trading and the capital markets heavy businesses of Goldman versus the lending business of Bank of America, but ultimately they all look pretty similar on the chart.
Absolutely, looking similar on the charts. Their issues that we're seeing in the reports are very similar. Yeah. And to your point, hitting these lows might be a reason we're seeing a slight uptick out of these reports today. If you look at Goldman Sachs, if I just said to you, hey, profit fell 48% and revenue fell 22%, you would think that investors aren't going to like this report, right? But some of those numbers still beat expectations. Earnings per share beat, revenue beat, even though it was down 22% year over year. Net interest income, of course, rose to about 1.73 billion. Investment bankers, though, their fees were down 41% lower than what we saw a year ago. Now, that still beat expectations. Global markets generated revenue up 32%. Fixed income, equities, both attributed to that. Consumer and wealth management, that rose by about 25%. Now, where we start to see some issues here again is asset management revenues, right? Those were down 79% year over year, but they did beat a lot of expectations out there. And, on the other side of that, their assets under supervision are rising. They rose by about 101 billion. If you include their NN Investment Partners acquisition, that number rose to about $2.5 trillion on asset under management.
Wow. Okay. All right. So a few notable kind of interesting stock stories for each, but we're going to need to see some of the general market improvement in the economic conditions for these banks to really start cranking. And a lot of that's going to come from loans reviving and interest rates going somewhere favorable, either lower so that all the volume goes back up, or spreads actually widen out so they make better margins. Something's going to have to give here for banks. Okay, let's talk that Boeing story. Kevin teased it to us a few times. Delta's ordering some jets. Hooray! Boeing's selling planes again.
That's right. It's been a while for Delta and Boeing to get together on an agreement here. Delta is ordering 100 more planes of the 737 MAX jets. The 100 planes are going to be worth about $13.5 billion at list price. Of course, there will be discounts that come into that. And the deal actually includes that Delta could have an option for 30 more of the jets as well. Delta didn't disclose how much they paid for it, but deliveries are set to happen in 2025. What's interesting about this deal, though, is that there is still a regulatory hurdle. Of course, with Boeing, that seems to be the case in every story, right? They're still waiting for the 737 MAX 10 to be approved by regulators. If it's not approved by the end of the year, they would be required to go in and upgrade their cockpit systems. That's possibly going to add more time. Delta says that they expect the FAA to sign off on the planes next year, but the company has said basically if they're not ready, then they may have to think or rethink what they're doing in terms of this deal. So it could be interesting to watch. It's interesting for Boeing certainly to have more orders coming in, especially when they're competing against companies like Airbus, which Delta has dealt with a lot in the past.
Okay. So the fact that we're getting purchases from a reluctant client is definitely helpful. And now we have to wait to see other airlines also confirm the orders. And then China, too, which is still a work in progress, right?
Yeah, absolutely. I mean, that approval process has been ongoing. We know that there have been more issues in terms of regulatory hurdles in China. To be fair to Boeing, we've also seen more orders come in from other companies. Japan company ANA Holdings ordered more airplanes from them. We know Boeing has seen some production and delivery slowdowns. They've had trouble with different systems like wiring connectors in the past. They certainly have these regulatory issues, but it's good news for Boeing anytime you hear that more planes are being ordered. Let's hope that this regulatory battle for their sake gets through fairly quickly so they could actually deliver these planes to Delta.
Okay. All right, Mr. Pierce. Nice. A lot going on with Boeing. So coming back and very unique to its own story. You know, the chart doesn't look like a lot else out there, but it is at least looking good, and it's 3.5 month long now, or 2.5 month long now, kind of series of higher highs and some higher lows too. Boeing now trading the best since its May earnings that we got that were also part of the downside when they lost money. So getting orders, of course, is a good step towards making money. Earnings on the 26th for Boeing. Okay. How about the cloud sector ahead of earnings, Jeff? We've got an analyst out that's got a bunch of price target cuts. It's like broad across the board. The Piper Sandler analyst has hit a bunch of these companies that have already been in a world of pain the last 6 months, but basically getting in line for the most part with some of the downsides. Still kind of notable, though, because there's a chance that maybe some of these analysts that are still way too bullish on these companies compared to the last 6 months, you think they might just wait till this earnings. If they've been hanging on to their price target all the way through all the carnage, why cut it right before earnings?
Yeah, it's interesting. I agree. It's interesting to watch this happen. And then also you can see the verbiage inside what the analysts talk to. And it's a little bit of what I think every investor is looking at with these stocks. To come in pre-earnings, it's an interesting take, but there weren't very many companies that were spared here. If we look at Salesforce, Twilio, Workday, Zendesk, Coupa, Snowflake, they were all lowered. Snowflake, they lowered the price target to 164 from 165, kept an overweight rating on the shares. The analyst said software subscription models with 85% plus reoccurring revenue streams, high gross margins, and secular tailwinds tied to cloud and digital might be better positioned to weather economic storms and cyclicals. However, he said these software models are not immune to a recession. He's proactively lowering their second half 2022 and 2023 estimates across the cloud applications and analytics coverage list. And he dropped price targets for them to better reflect an increasing economic challenge as they go ahead. Listen, we've watched these companies really start to blossom during the pandemic, 2020, 2021. Certainly, they have taken their hits. If you look across, there's some big numbers decreased in terms of percentages over the last 12 months on these stocks. If you're an investor, you're looking at two sides. There's this volatility in there, the fact that these companies, have not really done well because they're high growth companies. They haven't done as well in some of these economic concerns, some of these higher interest rate stories. Now, if you believe the companies are good in the long term, then you may have a very different view on whether or not they can weather the storm.
CRM, which arguably looks one of the strongest of this group that got these price target cuts, Snow, Workday, COUP, Twilio, CRM, the 5 in the list here. CRM looks decent, but it also is quite a bit softer than the broad tech index. That little pocket of trading that we're in there in the corner. I like the 5-year chart, shows us that we're kind of in still a very, very long-term pattern of higher lows, which would fit if we started rallying right now. But Salesforce actually looks weaker than the market because Salesforce is pretty well off its couple-month high, and the NASDAQ's pushing right up against it. So there's just really been a lot of negativity in the sector. Even as the markets try to come back, nobody's really buying the cloud stuff.
Yeah, absolutely. I mean, you look at Salesforce and Workday, they're, I guess you could say, winning over the last 12 months compared to the other names on this list.
Yeah, Workday,
they're down 29.
Miserable.
Right, exactly. Salesforce down, 29.5% coming into this morning. Workday down around 37%. Now, these names do carry a lot of weight. We certainly know that they saw quite a pickup in terms of revenue during the pandemic as companies kind of switched their model to work from home style. But having said that, these names have held on a little bit better than what we've seen out of Twilio, certainly out of Coupa software as well. It's going to be interesting to watch these companies go through as these interest rate stories continue. And to your point, are we going to continue to see kind of higher lows as we look at kind of the broader long-term view of these stocks?
Okay. Hey, Jeff, you excited about Google trading at $100? Alphabet's only $111 now. Amazing. What a deal.
Yeah, it's interesting. I do think it's exciting for investors out there that maybe wanted to get into these stocks, but frankly weren't interested in, paying over $2,000 to do it or weren't capable of it, right? And so now you've got these stocks trading at a lower price. Might add a little bit of volatility to them, but also adds some availability to more investors to be able to get in and purchase these companies. I think it's something we've seen it across other tech companies, right? Certainly Amazon, Apple, names like that. There's some different reasons for it, but one reason certainly can be it becomes more available for investors out there to actually go in and buy into these companies.
Okay. See, that's why I remember percentages and charts more than I do stock prices. Little known fact, I'm not very good at stock prices, but they can change. They mean nothing. It's just whatever they said it as. So I just know Google's down 22% on the year or whatever. Alphabet. Okay. Now it's 111 instead of $2,000. Easier to talk about. Helpful for us too. Thanks, Jeff Pierce. Easy to talk to. Thanks, Jeff, for the rundown here. Some of the big movers this morning.